Thank you for joining us at parttimetrader.net. We're going to get into the next course, why most people lose money in the stock market. So in this slide, we're going to talk, we're just kind of giving you a high level on that, how people are approaching the stock market. And really, in reality, most retail investors lose money because they treat the stock market like a casino. They're gambling. And did you know over 75% underperformed the market over 5 years? Warren Buffett nailed it. The market rewards patient, the patient, not impulse. So let's go over those common investing mistakes that investors make. There are three major mistakes. Number one, there's no clear plan. They're trying to time the market. Number two, and number three, they're letting emotions drive decisions. And they're doing this without goals and discipline. And what's happening is you're reacting instead of investing. Now, this is a common thing. They're chasing hot tips and they're failing to diversify. Hot tips can burn your portfolio. Instead, do your own research and diversify. Remember, the dot-com crash, I remember it personally. I actually started trading back in 1998 and I made a lot of money into the dot-com crash. And when it started crashing, lucky for me, I had some career changes. I made it and I was able to get out in time. There was a lot of concentration in trendy sectors like the high-tech sectors during the dot-com crash, and it wiped out entire portfolios. The other reason for losses is emotional decisions. This emotional decision making is where people do a lot of panic selling, a lot of FOMO, greed, buying. So most losses happen when we act emotionally, buying out of FOMO and selling from fear. Staying calm during ups and downs helps avoid costly regret. Let's talk about risk tolerance. Ignoring risk tolerance and time horizon. Your investment strategy must fit you. Young investors can take more risk. Older investors need more stability. Matching risk to your timeline helps you stay the course. Another problem is overtrading and high fees. Trading too often kills returns. Fees, taxes, and bad timing add up. Long-term, buy and hold investors tend to win because they minimize costs and avoid the noise. Not sticking to a strategy. Jumping from one strategy to another based on hype, for example, like chasing meme stocks, leads to losses. A strong plan only works if you stick to it, especially during market uncertainty. Now let's discuss how to avoid these pitfalls. You need to diversify. You need to know your risk. You need to think long-term. At parttimetrader.net, we stress risk management and discipline because smart investing isn't flashy, it's consistent. I want to thank you for joining me on this session and on to the next session.